Hello, and welcome to our channel. Wall Street just took another brutal hit, and the numbers tell a story of pure anxiety gripping the markets. On Friday, March 6, 2026, the Dow Jones Industrial Average plunged nearly 700 points right out of the gate, closing down 676 points, or 1.41%. The S&P 500 dropped 1.26%, and the tech-heavy Nasdaq shed a full 1%. Wall Street's famous fear gauge, the VIX, spiked another 12%, signaling that traders are bracing for more turbulence ahead. This wasn't an isolated dip. It capped a punishing week where the major indexes are on track for steep losses, driven by two powerful forces colliding at once: surging oil prices fueled by the escalating war with Iran, and unexpectedly weak U.S. jobs data that raised fresh doubts about the economy's strength. Let's start with the jobs report, because it landed like a thunderclap. The Bureau of Labor Statistics revealed this morning that the U.S. economy actually lost 92,000 jobs in February, far worse than the modest gains most economists had forecast. The unemployment rate ticked higher to 4.4%, and the underemployment rate climbed too. Revisions to prior months showed even less hiring than originally thought. This is the kind of data that normally screams recession warning and pushes the Federal Reserve toward aggressive rate cuts. But in today's environment, it's creating confusion and fear rather than clear relief.
Why?
Because the labor market weakness is now colliding head-on with a powerful inflationary threat: energy prices going vertical because of the Middle East war. U.S. crude oil surged another 9.2% today to $88.47 per barrel. Brent crude, the global benchmark, jumped 6.7% to $91.16 per barrel. That puts both benchmarks up an astonishing 32% and 25% respectively just this week. The reason is brutally simple: the conflict with Iran has effectively shut down the Strait of Hormuz. Nearly 20% of the world's daily oil consumption flows through that narrow waterway off Iran's coast. Tanker traffic has almost completely stopped. Insurers have pulled war risk coverage, shipping companies are refusing to sail, and even Qatar, the world's largest LNG exporter, has halted production after Iranian strikes on its facilities. President Trump posted on social media this morning, "There will be no deal with Iran except unconditional surrender." That language, combined with no visible off-ramp, has convinced traders that this war could drag on for weeks or months, not days. Qatar's energy minister, Saad Al-Kaabi, told the Financial Times today that he expects all Gulf energy exporters to be forced to shut down production if the fighting continues. That's not a forecast. That's a warning of potential catastrophe for global supply chains. The market math is unforgiving. Higher oil means higher gasoline, diesel, jet fuel, heating oil, and natural gas prices. Those costs ripple through every sector. Airlines raise fares, trucking companies increase shipping rates, manufacturers pay more for energy-intensive inputs, grocery stores pass along higher transportation and refrigeration costs. Inflation, already a lingering worry, suddenly looks like it could re-accelerate at the worst possible time. As Chief Market Technician Craig Johnson at Piper Sandler put it, the stock market is becoming increasingly vulnerable to turmoil in the Middle East, making the path of least resistance lower. Add to that the jobs report, and Wall Street is staring at a classic stagflationary mix: slowing growth plus rising prices. Ellen Zentner, chief economic strategist at Morgan Stanley Wealth Management, captured the Fed's dilemma perfectly. Significant weakening in the labor market would support a rate cut, but given the risk that higher-for-longer oil prices could trigger another inflation surge, the Fed may feel compelled to remain on the sidelines. David Russell at TradeStation echoed that trade uncertainty and a lack of population growth point toward a weaker economy. At the same time, energy prices spike. Treasury yields are reflecting that tension. The 10-year yield climbed to 4.17% today, up sharply from 3.96% at the start of the week, even after the weak jobs number. Normally, a soft jobs report pushes yields lower in anticipation of Fed easing.
Not now.
Bond investors are selling because they fear energy-driven inflation will keep rates higher for longer. The US dollar index, meanwhile, paused today but is still up 1.7% this week, its best weekly gain since late 2024, as investors flock to the greenback as a safe haven amid global uncertainty. This isn't just a US story. Asian markets extended their sell-off into Wednesday and Thursday trading. South Korea's Kospi has been crushed, Japan's Nikkei down sharply, Hong Kong's Hang Seng sliding. Europe's Stoxx 600 has taken repeated hits. Natural gas futures in Europe have exploded higher, up 24% Tuesday after 38% Monday, because Qatar's LNG shutdown threatens winter supply. Diesel futures continue to outpace crude, hammering trucking and shipping costs worldwide. The psychological toll is real. Traders who were betting on a quick, contained conflict are now facing the reality of a prolonged war. Every new headline, Iran threatening tankers, Israel striking Beirut and Tehran simultaneously, Gulf states intercepting missiles, adds fuel to the fire. Trump's "no deal except unconditional surrender" post this morning only deepen the sense that diplomacy is dead and escalation is the baseline scenario. For everyday Americans, the pain is already arriving at the pump. Gasoline prices jumped 11 cents in a single day earlier this week, the largest one-day increase since 2005, and analysts expect daily 5 to 10 cent rises until supply fears ease. Heating bills, airline tickets, grocery prices, delivery fees, everything touched by energy costs is going up fast. That squeezes consumer spending power at a moment when the labor market is softening and confidence is fragile. So, where does this leave investors? The path of least resistance, as Craig Johnson said, is lower for now. Volatility is likely to stay elevated until there's either a de-escalation signal or clarity on how long the Strait of Hormuz remains effectively closed. The combination of stagflation risks, geopolitical uncertainty, and a Fed caught between weak jobs and hot inflation creates a very tricky backdrop. Safe havens like gold and the dollar are seeing choppy moves, while energy stocks and defense names are the only consistent bright spots. This is a market being forced to price in a new reality, a major energy shock colliding with slowing growth. The next few days and weeks will be critical. If oil keeps climbing toward $100 or higher and jobs continue to weaken, the downside pressure on equities could intensify. But if a diplomatic breakthrough emerges, or if alternative supply routes ease the bottleneck, we could see a sharp relief rally. One thing is clear. The war in the Middle East is no longer just a geopolitical story. It's an economic story, a market-moving story, and increasingly a pocketbook story for millions of people around the world. What do you think? Will oil prices keep surging, or is a resolution closer than it feels? Are you worried about inflation, gas prices, or a potential recession? Drop your thoughts in the comments. I read them all. If this breakdown helped you make sense of today's chaos, hit that like button, subscribe if you're new here, and turn on notifications so you never miss an update on markets, the war, or the economy. Thank you so much for watching. Stay smart out there, protect your portfolio, and we'll see you in the next one.